Hi everyone, welcome to the Timing Research Show for July 11th, 2016. Today we will be talking about the 146th report from Timing Research. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports and you can download this or any past report there. I have Matt Buckley hosting for me again this week, so I'm going to go ahead and turn it over to him.
Thanks, David. Appreciate it. Good afternoon, folks, or good evening, good morning, wherever you're joining us from around the United States or the world. My name is Matthew Buckley. My call sign is Whiz. You guys can refer to me as Whiz going forward. I'm going to be your host for today. We have a lot to talk about, man. I mean, last week was every day of the week something massive happened, from Hillary Clinton more or less being indicted for perjury for 6 counts by the FBI director to unfortunately what happened in Dallas, and then the jobs report. I mean, from the market to politics in the United States, it really does feel like it's going to be a long, hot summer. So David's done a great job once again of rounding up some 500-pound heads, so we're going to have a great session this afternoon. Mark Sebastian of Option Pit, Adam Johnson of BullseyeBrief.com. It's a new service that's come out recently, and he's blowing the doors off of it, which is great. So we're going to hear more about that. James Ramelli, my buddy at Alpha Shark, and Neil Batho of TraderReview.com. So hey, gents, we're going to keep that order today as we go through our questions and our discussion. Mark, Adam, James, Neil. But let's kick everybody off with Mark. Do us a favor, tell us a little bit about yourself, your background, and what you do at OptionPit.com.
Yeah, thanks for having me on the show. I'm excited to be here. I was a floor trader for about a decade with Group 1, and then I went off on my own. After I left the floor, started working in education consulting. On the education front, I work with kind of the retail trading public, trying to teach them a professional approach to trading and risk. And on the institutional side, I'll work with money managers, asset managers, hedge funds, and help them construct, stress test, and optimize option strategies against what they're doing. We also, my group also runs a hedge fund on the side, and that is called Carmen Line Capital. That is mostly volatility arbitrage. That is the elevator synopsis of my life.
That's awesome, Mark. Are you up in Chicago, obviously, or?
Yeah, we're Option Pit's headquartered in Chicago. Right now, I'm actually I'm on a deck looking out over a lake. I'm remote working from Grand Junction, Michigan, which is about 20 miles east of South Haven. So okay. Tons of Chicago people here, but not in Chicago itself.
Okay, roger that. Yeah, I came from I was the managing director of strategy of Peak 6 Investments there in Chicago. So.
Oh, nice guys.
Yeah, I know the Vol Arb story very, very well. So maybe you and I offline can chat, because it sounds like it's similar background. Okay, Mark, welcome aboard. Adam, tell us a little bit about yourself, your background, and what you do for Bullseye Brief, or about that service, actually. Sorry.
Yeah, hey, thanks, Whiz. So I just launched Bullseye Brief about 6-7 weeks ago, and it's effectively the 3 ideas that I think are most worthy of your time every 2 weeks. And that's a philosophy that really I adopted as my own back when I was running money. This was on the hedge fund side. Before that, Furman Sells, ING Asset Management. And I would tell brokers, you don't need to call me every day. You don't need to call me every week. Just call me when there's something that excites you, and let's talk about it. And if we like it, we're going to do it in size, and we're going to do the whole thing through you. So that's Bullseye Brief. Prior to Bullseye, I was at Bloomberg. I was anchoring a couple hours every day. I did the morning show for a couple of hours, the afternoon show with Trish Regan. Had a lot of fun doing that. And the only reason I ended up at Bloomberg was I'd been going on CNBC as a guest back in 2008. And Bloomberg said, you know, the world's imploding. We need someone who can talk intelligently. And I don't know, one thing led to another, and I found myself on television for 5.5 years. But the siren song of trading and analyzing markets is powerful. And I absolutely love doing the work, and that's why I launched Bullseye Brief. Again, it's just trying to help people see something they hadn't seen, and only putting like 3 ideas in front of them every 2 weeks. You can say, this is what you need to focus on. Right now, something I like a lot is one Italian bank. I went through the entire universe of Italian banks. I found the one with the the highest capitalization and the lowest default rate in all of Europe. As a matter of fact, it's lower than what you have here in the U.S. So it's opportunities like that. Sometimes it's one stock, sometimes it's a group, but it's a lot of fun and it's keeping me busy.
Now, what Adam failed to say there is that the Italian bank is actually named Tony, and he's from Sicily, and he'll hit you up if you don't pay him on time. That's the good low default rate there.
Hit you up in the keyword, right? Hey,
exactly.
Awesome. All right, Adam, welcome aboard, my friend. And James, tell us a little bit about yourself, your background, and what you do at Alpha Shark.
Sure thing. So my name is James Ramelli. I'm a trader and moderator here at Alpha Shark Trading, and our entire approach to trading and navigating financial markets all has to do with institutional order flow. So every part of my day revolves around looking at options order flow, figuring out what big hedge funds and institutional money is buying and selling in the equity options market, and then trying to figure out what that actually means for those underlying stocks, indices, and ETFs that they're doing all that order flow in. Supporting that, we have a bunch of education that we offer our customers on how to read the tape, on how to use order flow in their trading plan, whether you're a day trader, a swing trader, or someone who's a longer-term investor. And we also have some software products that actually help those traders find that order flow out of the just massive pile of equity options orders that hit the tape in a day, figuring out which ones are the most interesting and the most suspicious, the most unusual, and in that process we end up catching a whole lot of insider traders that the SEC just happens to miss. You would be absolutely shocked at just how often ahead of an M&A deal or some type of catalyst event in a stock that shouldn't be public or is non-public, there is some type of order flow ahead of that telegraphs that perfectly. So that's basically what I try to do all day long.
You getting a payout from the DOJ on finding these guys?
You know what? I honestly think that I would do a better job of most of the people at the SEC. I'm absolutely shocked on a daily basis at just how many orders that are blatantly, obviously insider trading come across the tape minutes, hours, or a couple of days ahead of some type of massive announcement. LinkedIn, we saw this happen. We saw this happen with, I can think of 5 names this year. I mean,
so are you saying that those Hershey par calls that somebody bought 20,000 of were not just by luck?
He'd be the luckiest trader. He'd be the luckiest trader in the world if that was the case. It's pretty amazing, and we can take a look at some examples a little further on here. But you would be shocked after you watch order flow for 1 week, and you'd be amazed at how often it happens.
We talked, James, a couple months ago, I think it was, about the order flow issue, and I still have a lot of buddies. Actually, one of them just made 2-star Admiral a couple weeks ago. I got a lot of buddies up north in the ring, and they just laugh at how much inside. Well, I guess it's outsider. Let's call it outsider trading. We talked about how the People's Liberation Army in China has an entire division, an IT division, assigned to reading Goldman Sachs, Morgan Stanley, J.P. Morgan, all these guys' emails. So they know about these deals, and they trade in front of it. They're actually making money off of this, and you're correct. I think people think about the odds, like, well, they don't catch a lot of us doing insider trading every once in a while, so they're playing the odds. So we'll talk about this a little bit more in a bit, because I think it's very interesting to all the listeners that they, we talked about it in the old days, James, how somebody walked in the pit and said, hey, give me 10,000 of the Facebook 120 August calls. We'd all look at that and go, he's either drunk or he knows something. So and occasionally he was drunk, but I digress. But yeah, taking a look at order flows is a pretty big deal. So we'll talk about that in a little bit, I'm sure. And finally, Neil, why don't you give us a heads up, Neil, of your background and what do you do for Trader Review?
Sure. Thanks for having me on, Matt. I use a top-down analysis. I use technicals. I use point and figure as my main methodology, and I use the Ichimoku cloud. I put them together. And I'm not afraid to be in cash when things are bad or going short, and then when things look really good and they turn around, I'm not afraid to jump in with both feet either. So I'll send out my reports every day, whether we're trading or not, and give updates. and really focus on the entry point, because I find if you get the entry point right, everything else sort of takes care of itself.
Okay, I like the way that sounds. All right, gents, let's go ahead and get airborne and kick off with our first question. This will be to you, Mark. What direction do you think the S&P 500 index will move from this coming Monday's open, this morning's open, to Friday's close on July 15th?
Oh, well, that, because what I do is predict direction. I think that, it depends. I think there is a high odds that a Fed governor or two with voting privileges starts rabble-rousing about interest rates. Right now they've got interest rates priced in at maybe a one more 25 basis point raise for the year. I think the Fed wants to do more. The S&P is recovered all the way. It's now at an all-time high as we're talking right now. That gives the Fed kind of clearance, and as long if the pound really does stabilize, which it appears it's starting to do, I think they're going to feel pretty clear to get a little more aggressive. I think there's still 2 rate hikes on the table, one in September, one in December. I think that you could see some action out of the interest rate market, and I think we could see somebody talk as early as this week. Now, if they keep their mouth shut, there's a lot of people that are short calls. I think you could see a lot of short covering of kind of option premium, and that could run the market up. So here's what I will say. I will say that I think we're going to run to 21.75, but if one of those Fed governors opens their mouth, I think we've got a trip back below 2100 on the tape, maybe back to 2050. So just keep an eye out for whether any of them are scheduled to speak, and look at those as trading opportunities.
I think who was it? Esther George or whoever was quoted as saying, "Yeah, we're way economy's fine. We're way past the point that we need to be raising rates." So those are all good points. So you think we're going to be higher by Friday's close or lower from this morning?
I mean, I would probably say higher. That's going to be, given any 50-50, given any scenario where you don't have an opinion, and I don't have a strong one, you should say higher, because that is kind of, if you look at the 10-year note, it's trading 1.3%. We used to call it the Tina trade. There is no alternative but equities, and if you want dividend, you want yield, you want any of that, it's going to push stocks higher. So, and the other piece, everybody is so ridiculously bearish that the market has to go higher, and so yeah, I'm going to say higher.
Yeah, you can't fight the Fed, and you can't fight the trend. And I like to tell my traders at Top Gun Options, you can't. You got to trade the market you have, not the market you want. I think most of us might take a look around at what's going on and say, you know what, the economy pretty much is. It sucks. It's probably on life support, and maybe sitting there comfortably in life support, but it ain't good. But here we are at all-time highs. So the economy and the stock market are completely in 2 different worlds, but those things are going to have to collide eventually. So I agree with a lot of what you said. So Adam, how about you? Where do you think we close on Friday? Higher or lower from Monday's open?
Yeah, higher. I am on board with what Mark just said on 2 of his 3 points, and radically against him based on data on the 3rd. Number 1, agreed. We're going higher. The suspension of disbelief continues, and here we are today, beginning another earnings season. It's going to likely be the 6th consecutive quarter of earnings declines, and yet none of that matters, because we have a global central bank bear hug. Central banks around the world have made perfectly clear that they're going to do whatever it takes, quote unquote, Mr. Draghi, and even Ms. Yellen last week, citing what's happening in England. They're going to do whatever it takes to keep reinflating assets. It's completely artificial. It doesn't work when you sit down and think about it sort of in a vacuum, but it's what's happening. It's the world in which we live, and I guess that's your point, Whiz, that this is we may not like this market, may not like what the Fed is doing, we may disagree with it, but That's what they're doing, and they're going to inflate assets and keep pushing stuff up. The one point where, Mark, I completely disagree with you, and it's not me, actually. It's just the market. I tweeted out this photo. This is basically just my Twitter feed, which is the Bloomberg page on Fed funds probabilities. And I'm pointing my finger right to it, September 20th, 2017. All right? That's like 15 months from now. That's the first meeting where you actually get better than 50% odds of a rate hike, and it's only 50.1%. So it's still a coin toss going out 15 months. That coupled with the fact that you've got the 210 spread right now at about 75 bips tells me you've only got 3 rate hikes being priced in between years 2 and 10. So it's crazy. They're going to keep rates low, which means, Tina, your third point, Mark, there is no alternative. You have to go into equities. Even if you're paying a multiple you don't want, even if there's not growth, because you're not getting any kind of return in the fixed income sector. No return that, justifies being there long term. So, Mark, you and I are on the same page, at least on 2 or 3 points. We're going higher. There is no alternative, but I do think that the Fed is sidelined for a long time.
Yeah, it's great points. Especially, I'm not a believer, definitely, in a fall rate hike. I don't think Ms. Yellen is that. I'll be nice, stupid to poke her nose into the middle of an election season and become a political football. So I don't think the Fed's raising in the fall. And that's a great point about the Fed fund futures being a year out, which is just absolutely incredible. And it doesn't look like there's any more stability on the horizon from, they've kind of gone quiet on us, but China is still that. It's like that, I grew up watching the $6 Million Man, Steve Austin, just tumbling down the runway. That's kind of what China's doing. So I think she's got enough air cover for a long enough time to say, hey, we're just going to, sit on our hands and look cautious and be ready and all that long Fed speak. So, yeah, you really can't fight the Fed. Those are really great points, guys. James, how about you? Higher or lower by Friday?
Yeah, so I think we're going to end up higher from this morning's open by Friday. Probably not a whole lot higher than we are today. I think we'll probably kind of chop around into the end of the week. If we take a look at what the market makers are actually looking for this week, they're looking for about 19 points worth of action in the S&P futures between now and Friday. That's what they're pricing the at-the-money straddle at right now. It is interesting to see, though, that as we're making new highs, the market's up 14 handles right now, and the VIX is actually getting a little bit of a bid. So traders out there obviously looking for some type of protection here. One of the things that we've noticed over the past week, last week, was that order flow was a little thin. We were tracking kind of, less than usual number of large block trades. So I think that maybe institutional traders are just kind of sitting on their hands here waiting until we get into the next earnings cycle. I pay attention to earnings quite a bit. I like to trade stocks ahead of earnings with options. Alcoa reports today. Like Adam said, earnings are not going to be good this quarter. Everyone expects them to not be good, but that doesn't really matter either. Right, we'll probably see a whole lot of buybacks. We'll probably see some pretty highly engineered reports throughout this quarter. So I think that until we get a good picture of what the economy actually looks like from corporate profits, those big traders might be sitting on their hands, and we're probably just going to slowly grind higher until we get a little bit deeper into the cycle.
I think that's another great point, James. I tell my traders at Topkin Options, market up, VIX up, something's up. And with a near triple digit, or there was a triple digit gain on the Dow, took a peek up over at the VIX, it was up 2%. So I don't know if this is a
you got a little bit of you do have a little bit of a weekend effect on Mondays that can affect things. So coming in on Monday, you expect VIX to be up about 3/4 of a point. So I would look at today's action as basically unchanged. One thing that sorry, I don't mean to stomp on you, Whiz, but
no, go ahead.
One thing I think that is going to affect kind of VIX itself is that you have this kind of plastering of covered calling everywhere in the market. I mean, it's amazing. 10 years ago, nobody traded covered calls. Now just about every trader in the world is out there just plastering kind of the first call out of the money, looking for, again, yield, the TINA.
Yeah.
And then what we have, when we get a big rally that nobody's expecting, you have these guys that don't want to lose their stock racing to cover their short call positions, and that actually can push VIX a little higher too. So I think we're seeing a little bit of that, but yes, you're right. Market up, VIX up, something's up.
Yeah, it's just interesting. As we climb up to record highs here, I do think when, the other saying is when vol is cheap, you buy it. When vol is expensive, you sell it. So I think I think a lot of the smart institutional money, or at least I am in some of my portfolios, when we get this high on what I believe is kind of I call it a MacGyver market. We're up here on a straw, a paperclip, and bubble gum. I kind of walk over here and go, pay no attention to me. I'm just going to go get some protection right now while it's cheap. I'm sitting down here in South Florida, and you don't buy hurricane insurance when the Channel 5 News says there's a tropical depression over the Bahamas. You do it when it's a day like today. It's beautiful out and everything's great. So good points, definitely good points. Neil, how about you, man? Higher or lower by Friday?
Yeah, I think the market's absolutely going to go higher. I guess we'll give like a 90% on that. And I think the big reason is the market's basically been consolidating for a year and a half now, and finally broke out. And all of my main indicators have turned up that I use, and they usually turn up for at least a few weeks. One of them is bullish percent. Only 63% of stocks are on breakout buy signals in the near term, so that tells me there's a lot more to go. And really the markets, people are going to get in, because if they don't get in now, they're going to be afraid that the market's going to get away from them, which I think it will. So definitely bullish all week.
Wow, we got a lot of bulls. The best thing about being the host and going last is telling everybody they're wrong.
No, here it comes. Oh.
No, you guys. No, I agree. Obviously, again, you trade the market you have, not the one you want. That post-Brexit bounce, we got everything back that we lost, and we chopped to the right a little bit, which made sense. We're all the Brexit to me was like a face slap where everybody stood around and rubbed their face and looked at each other like, okay, now what do we, that just happened. Now what are we going to do? And then we decided to have this rip your face off rally about the jobs report, which the headline number was just obviously great. Did anybody look at the revision to the previous month? The previous month was 38,000 jobs. There's about the same amount of civilian jobs on a naval air station in San Diego I was based at. It was revised down to 11,000. I can't even. Is that a joke? That's a national embarrassment.
But that's why you look at the 3-month average, and you're right. It was a crazy, crazy month, but all of a sudden we get it all back the next month.
Well, that's exactly right. So when you average out, it's still around that $150 to 200 range that we've been plowing for about 18 months. But one of the other things that troubled me about last week's jobs report was 90% of the June job gains went to workers 55 and older. So again, a lot of retail traders tend to trade the headline, but if you look in, down the horizon, you really have to get into the guts of the report sometimes, and that's the job of, folks like us on this webinar to provide for our subscribers and folks who want to follow us. But I was stunned. I'm like, wow, that's a good number. And then you start digging. So, we're growing our economy on my grandmother going to be a barista at Starbucks. I don't see that happening. But you guys are right. I think we close higher by the end of the week. But whoever said not by much, that's who I agree with. I think we're getting hypoxic up here. We're kind of Mount Everest up here. And a lot of the hedge funds that I talk to, a lot of the smart money, quote unquote, all that type of stuff, they're trying to put money to work in equities. As you all, I think, Mark, you pointed out, you're like, hey, where are you going to put your money? In a Folgers can in the yard or under your mattress? It's just, you have to deploy that capital somewhere. So I get that it's still U.S. money, but a majority of the inflows that I saw last week were from foreign country. It was foreign capital. When you think about it, we're the best house in a really crappy neighborhood when you look around the world. So where are you going to put your money to work? So that's, and actually people are, as I think somebody brought up earlier, bonds. Look at the yield on the 10 and the 30. I mean, it's we're going to be Germany soon. You're going to be paying the government for the honor of them watching your money. It's crazy. So, but I think you guys are right. So following up on that question, Mark, what's your confidence in where we're heading this week?
Like I said, I think that there is some serious potential for upside. I'm still wary that, Adam's right. If I believed and trusted the Fed's intelligence, and I don't, and I think that there is a real chance that probably not Yellen, but some Fed governors could start yapping, open their mouths, saying, "Hey, now that everything's back to hunky dory, and the 10-year is 1.3%, why don't we raise short-term rates?" I mean, we could see a real flattening of the yield curve. I think that basically what I'm saying is I think the way they've priced in bonds right now, they're wrong. I think that there is a much greater chance of 2 rate hikes, of at least 1 rate hike this year, and maybe 2 before it's all said and done. And I think that could push things. But am I overly confident in the market right now? Yeah, unless outside forces, outside uneducated, silly forces open their mouth. And with the Fed, it's like they open their mouth to change feet.
That's a good point, and it's scary how much a Fed lieutenant can change, can move the market. It's just shocking to me. Or even a reporter at Hilsenrath at the Journal, man, he can even throw the markets around a little bit. So okay, Adam, how about you? What's your delta? What's your percentage of confidence on your call for this week?
Yeah, I wish I weren't as confident as I am, because I've learned that anytime I'm confident, I should be looking over my shoulder. But there's no other place to go, Whiz. It's just crazy. Look, with the 10-year at 142, which is, it's just insane with what's happening in Europe, with the flattening of the curve. 76 basis points between the 2 and the 10. Where are you going to go other than stocks? It makes me very uncomfortable. But that's where the money's going. I hate to say it, but I do think we're going up. And by the way, there's a piece, and I know this has kind of been circulating around the street. A lot of trading desks have seen this data, but the one that I've read most recently is from TimingResearch. The technical guy over there, Chris Verone, very good. He used to come on the show, my Bloomberg show a couple of years ago. I think he's really good. And he's made the point, if you go back the previous 3 times when you had periods of more than 1 year, 1 calendar year of no new highs, as effectively we've been experiencing, you then had rallies over the next 12 months that went anywhere from, I believe it's 12 to 36%. It was like 12, 22, 36. So it's that notion, and I think you may have said it, Wiz, that it's one of you guys said it, that we're just so pent up. We've been sideways for 2.5 years, and even though valuations are high, there's nowhere else to go. So all of a sudden you start saying, wait a minute, is this really the only place to go? I need to get in now, and you have some sort of lift-off, blow-off, call it whatever you like. But anyway, my confidence is we are going higher.
Okay, so very certain that we're going higher. Got it. James.
Yeah, so I have a fairly high delta on that. I would almost say it's like an 80 delta that we finished the week higher. And honestly, mostly because we're up to as much as we are today. This is kind of an outsized move for the market to be up 15 handles today. We're getting a really nice start to the week. Last night, when the futures opened, they were only pricing in about 22 handles worth of action through last night's open through Friday's close, and we've got 15 points worth of that already today. They're still looking for about that same amount, but with vol so cheap here and the VIX so low, I just don't see a big considerable move lower. Alcoa is going to have earnings today. They're probably going to be bad. The stock's probably going to go down. That's not really going to give the market much of a reason to sell off. If we get into the end of the week and some of the first financials that start to report have just dismal earnings, maybe we see a move lower, but I'm fairly confident that it's, even if the earnings aren't that great, it's not gonna matter too much to the market this week.
Okay. Okay. Good points. Neil.
Yeah, I'm going to go with 90% just because, we've been consolidating for 1.5 years, almost 2 years here, and, I also think that there's a lot of fund managers out there who are paid their bonuses if they outperform the S&P 500. So what are they going to do with all their money when they see something like this? They're going to have to go in. Otherwise, they're going to miss out on their bonus at the end of the year. So, you'd have to be crazy not to get in. And the covering on the people that are short the calls as well. And I think the train's been at the station for such a long time now. You thought, should I get in? No, I got faked out. Should I get in? No, I got faked out. And now you're just going to have to get in. People are just going to have to get in. And I mean, I'd say 90% this week. Next week, I have no idea. And for the rest of the year, I'm not sure either. But for now, absolutely 90%. I mean, got to go in this week for sure.
So Neil, you think some of this rally that we're seeing recently is a regret rally? People, saying I got to get in. It's going up.
I think so. I mean, one of the biggest mistakes, I'd say probably the biggest mistake you can ever make in trading is trying to get in, trying to time the breakout. It looks like it's going to be a triple top break. I'm just going to get in now because I'll get a little bit more, and then it falls back. Then it falls. How many people have done it? You say, no, this time it's different. I swear to God. And don't try to time those breakouts before they occur. Just wait. Say, I'll make a little bit less. When it goes down, you're sure glad that you do. But this time, it's not a fake out. I mean, this is real. Mm-hmm. So what do you got to lose? I mean, you'd have a lot more to lose if you didn't get in. So
true.
Yeah.
Okay. All right, good. So let's head to question number, I believe, 4. And it's we asked the respondents, if you could spend a day with a professional trader, what would you most like to learn from them? But I'll ask you guys, as a professional trader, what is something that you think you might have learned earlier in your career from spending a day with a professional trader? Maybe one of those nuggets there, Mark, of one of your keys to success as a professional trader that you might pass on to some of these young Jedis.
Well, I think the biggest thing to understand is that it's only a good trade when you close it, and take profits. And the big thing I always push is Alec Baldwin and Glenn Ross. And I tell my clients, I go A, B, C, always be closing, always be closing. Take profits, take losses quickly, and get out of the way. And that is the number one thing the retail public doesn't do. One of the single dumbest things that 95% of the retail public does is they don't close out trades because they don't want to pay a commission. Commissions should not be a part of your thought process when you're trading. This is so close your trades, take profits, get out of the way.
Put that coffee down. That's great advice. Great.
Coffee is for closers.
Coffee is for closers. Exactly. That's awesome. All right, Adam, how about you? What's one of those nuggets that you got early on in your career?
Know your names. Know why you're in it. I'm not comfortable just indexing myself to the market, and even though we're all of us kind of pulled up on what's happening, at least this week, I'd rather know specific names. Maybe it's the one Italian bank that I want to own. Maybe it's NXPI, which is #1 in semiconductors, both for payments as well as autos. Maybe it's Bank of the Ozarks, which has shockingly high 400 basis point net interest margins because it's accretive and it's very good at acquisitions, integrating acquisitions. I want to know all these individual stories. I want to know why I'm there. I don't necessarily want to index myself to the market.
Okay, that's definitely good advice. Okay, James.
Yeah, so I'm actually going to kind of steal Mark and AJ's answer and combine them. I think that what Mark said about taking profits is super important, but I kind of like to use, just like AJ said, when I'm looking for something, I might have a thesis on a sector or an index, but when we're talking about things like that, it's really important to find what the most effective and efficient way to go about expressing that view is. So if I have a view on the tech sector, what I like to do is take a look at what's the strongest name that I can find in that's going to move the best with whatever my opinion is on the broader sector. So not indexing yourself is really important, but just like Mark said, I think the one thing that I learned early on that was the most useful thing to me that I didn't know before was about taking profits. A lot of traders think about risk management as protecting themselves from losses, but you also have to realize that if you're right in a trade, and if you're really right in a trade, and it goes your way and increases in value, that actually increases your risk as well. Or if I buy a share of stock for $100 and it goes to 105, my risk is now 105. It's not $100 anymore. It's increased.
Correct.
So that's something that most traders don't really realize, and they like to stay in trades way too long. I have a very good friend of mine who really didn't know a whole lot about trading, just kind of dabbled in options in his spare time. Actually, a really lucky thing happened to him. He was able to catch some puts in VRX before their earnings back in March, when the stock fell from $68 to 33 and change overnight. He had puts that went from $1 to like $12 overnight, and didn't get out of the position. Let it go for a couple of days, and it ended up working out. But you have to understand that you need to take profits if you want to properly manage your risk. It's just as important, if not more important, than protecting yourself from losses.
Mm-hmm. Well, very well put, James. Neil, one of your nuggets from early on.
Well, I think a lot of people are always taught you should just hold basically forever. And that can work sometimes in the major indices like the S&P 500, but people forget that those indices actually change every year. So you're technically actually trading if you're holding these indices. And a lot of people seem to think I should just hold everything. I should hold, my call options that are up 1,000%. I should hold, this stock. And like a lot of people, if you don't get stopped out, usually when things go up, you're a technical analyst. And when things go down your way, everyone seems to become some sort of fundamental analyst. And they try to dig for all these little bits of information, trying to convince themselves that they're a genius for holding because there's this new great product the company has that nobody knows about. Only I know about it, and therefore it's going to go up. But overall, I think what you need to do is think about what you want out of this trade before you get in. If it's going to be in something in an index, you're looking for maybe a 10% move maximum over several months. If it's a small biotech stock, it's really volatile, you're looking for maybe 30%. And when you see the patterns that you're always looking for, you have to get in without hesitation, because if you wait one day, you're going to miss quite often a lot of that gain. So you have to get in without hesitation, and you have to set your stops, and you have to commit to those stops. And even if you do get stopped out, don't be afraid to get back into that trade even a couple of days later, because some of the best traders in the world, they'll get stopped out on bottoms trying to hit a bottom. They'll get stopped out once, twice, even 3 times, but then that 3rd or 4th time you get back in, you're really going to get that rally. So don't be afraid to get stopped out and get back in.
More good nuggets. I when I was learning, obviously the name Top Gun Options came from me flying for the Navy for 15 years, and I taught myself how to trade options in the early 90s before the whole internet thing started to take off. But I started to apply everything I was learning flying a fighter jet to trading, because trading's a form of combat. And one of the things that we do first when we're talking about going into combat or any sortie is risk management. How are we going to get killed? So I think you guys nailed it. We, managing risk or taking profits, all those things, knowing when to get out of a bad situation in a fighter jet's absolutely critical, or you don't come home. Your wife gets a flag, and that's about it. So I think you guys nailed it. I stress risk management with my TGO folks. And
your average retail trader would get fired within a week if they worked for a professional shop.
Isn't that true?
It is. The amount of risk they take on is just shocking, and the inability to close. It is absolutely shocking. Fight for the best commission you possibly can on your trades, and then forget about it, and don't worry about it, and don't let it affect your trading. And because it's amazing, how much opportunity gets left on the table because you're sitting in a trade that's already won, or a trade that you're not going to win on, and you just tie up margin. It's just it is shocking. And one more comment. The leaving your position on when you go on vacation. I got to lay into somebody they turned a $2,500 trip to the Bahamas into a $40,000 trip because they were like, well, just leave it on and not worry about it. I'm sure it'll work out. And guess what? It didn't. So just piling on that with everybody on board, close your trades.
Yeah, and it's funny, Mark, because you and I both know that in a real trading room with professional traders, Peak 6 or Option 1 or whatever, when you went on vacation, somebody had your book, somebody watched your positions. So if you think going to the Bahamas and smoking the blunt is okay, and nobody's watching your portfolio, it's crazy. You should be thin on vacation, not have any positions on unless you do have a wingman to watch that. So you're right. The average retail trader wouldn't last 30 minutes past the open in a professional firm because there is no risk management. I talk to people, I have this trade on 50 contracts, Apple. I'm like, well, why 50 contracts? Well, that's my normal contract size. How much risk is that? I don't know, 15,000. Oh, that's great, 15 grand. Is that no? Did you know you had 15,000? No, I thought it was a couple grand. Well, okay. I hope it works out for you, and hope ain't a strategy. So, all good points. And folks, if for everybody listening today, if you listen to Mark, Adam, James, Neil, and I, it was a lot of defense talk, wasn't it? I mean, and we were talking, I think, offline before. I think, Adam, when you were talking about your bullseye brief with your win percentage, and this will be shocking to many of the folks listening, the average professional trader is looking to win about 60% of the time. And when you tell that to a retail trader, their eyes fall out because they want to win on every trade, whereas a professional like us know that's physically impossible. If you step up to the plate swinging for every trade, you might hit a couple over the fence. You're going to strike out a hell of a lot more, and you're going to be done. So I think, Adam, your newsletter had like a 74, 70-ish% hit rate, which is well above average for the professional trader. So, and maybe we can talk about that in a little bit.
Yeah, when I actually ran the numbers and I looked at it, I high-fived myself because I thought, wow, 71%. I actually, I was very happy with that. And you're right, it's like a very different orientation when you.
Correct. I'm used to dealing with a lot of new folks getting ready to trade options, and they're stunned. They have this look on their face like, "What's your?" My desired win rate is right around there at about 70. So above the professional average of 60. So I think that's great. So okay.
And by the way, Whiz,
go ahead.
At what point do you stop yourself out? If something goes against you, is it 4%, 8%, 15%? What's sort of the number where you say it didn't work out?
Correct, exactly. A lot of retail traders don't have that. I call it the eject point. Hey, this is when I'm giving this jet back to the taxpayers, man. The jet's on fire. My wingman's screaming at me to eject, and they're smoking the cockpit. That ain't the time to scratch my chin and go, maybe I'll earn a medal by saving this airplane. Rarely happens. Usually you get killed. So get out of the airplane, pick that eject point, 5%, 50%, whatever that percentage is for you, and then bail out. All right, so I'm going to change it up a little bit, fellas. I'm going to hit you with a little bit of a surprise question here, but based on how you guys are all talking, this ain't going to be a surprise. So I'm going to ask you, what is a good what do you have on your radar right now? Is a good short-term trade, whether it's for the week, I don't know, for the day, or something out to January of 2018 using leaps or something like that? Give the listeners a nice juicy trade that you currently have on your radar, Mark. And I know you're sitting on the deck, Mark. So
no, it's fine.
You probably have some good ones.
I continue to think that it's actually, I'm here with my whole family. I was talking to my father about Facebook, and he looks at me and goes, well, aren't all the kids using Instagram? And I said, Facebook owns Instagram. He goes, oh. I think Facebook is going to be the most valuable company in the world in about 18 months. I think they're going to fly by everybody. They seem to gap up at every earnings. If you go out to 2018 and you ask for a 2018 trade, I'm going to give you one. If you got to 2018, the Jan 2018 150 calls are only about $7. I think that's a steal, and because I think it'll be by, what is that, 18 months from now, I think Facebook will be approaching 200. I think they're going to pick up 150, 200 billion in market cap between now and this time next year. and those calls will be worth, 50, 60 bucks. The other trade, I'm looking at, I think, kind of across the board, I'm looking at just out of the money calls as a potential purchase, as trying to get out in front of these managers that are racing to cover all the calls they sold. So I think there's a lot of opportunity in owning August immediate upside calls.
Could not agree more. We are long. We have a long call diagonal to protect a put out to Jan 18 in one of our portfolios. It's just it's print money, and I think these guys, they've cracked the code. What are they? The second largest. Third or fourth largest country in the world or whatever, based on their user base. In the beginning, I was a little bit of a seller. How's he going to monetize all these eyeballs? Well, he just showed me for the past year and a half. So I'm done being a Facebook skeptic. I'm on board with you, and I agree with that trade totally, Mark. Adam, how about over to you? I know you have your good ideas, or why don't you tell us a little bit about that, and then give us one of those good ideas.
I like dividend-paying stocks in the UK. And they have made a huge move, obviously, over the past week, and they are still buys. There are so many high-quality companies trading with yields of anywhere from 6 to 7.5% in the UK. They've simply been penalized by the fact that they're in the UK, there's uncertainty, and yet the dividend streams are very strong. I ran a screen looking at UK stocks for growing earnings, for increasing dividend payouts, and yield above 6%. I found 9 names. Some of them, by the way, even have ADRs, American Depository Receipts. So you can trade them here in the U.S. These are companies that you can simply buy and put in your portfolio. You don't have to worry about them, and you're going to be paid while you wait, basically, with considerable dividends. And for those among us who enjoy selling premium, you can sell short-dated calls against these positions. I always prefer selling short-dated calls simply because, as you guys all know, the vol collapses, and therefore add to your total return. So you just go to Bullseye Brief, and you'll find them right there. Rule Britannia. Just look for the bulldog in front of a British flag and click on that, and you'll see the names in there.
With a drink and a big pint. Well said. And yeah, also being that I love being a short-term seller of options, obviously, too, because we get that theta, we get that time decay that just eats away. Unched on the day equals time decay. Some folks don't get that. I'm like, when they buy spreads or buy calls or anything like that, I'm like, hey, I'm a little cheap. Why don't we sell something against that to help pay? But that's great. Okay, so yeah, we should definitely check that out, Adam. James, over to you. What's tell us something you're liking right now or down the road?
Yeah, so I actually, on Friday, basically flattened out my book. It's something I typically tend to do into the start of the new quarter's earnings cycle. But another reason that I did that was because I didn't want to be long premium in an environment where it was just getting smoked on a daily basis. What I'm looking at right now, and I think probably one of the better opportunities this week, is getting short Alcoa ahead of earnings. Typically, I would never advocate for buying of puts outright ahead of earnings. However, in Alcoa, the stock is so cheap, it's trading at around $10.10 right now, that I can buy puts relatively cheaply on a dollar amount basis, and it doesn't really make a whole lot of sense to do a spread because the further out of the money options just don't have that much premium. With that being said, the stock has run up a whole lot in the last couple of days here, a lot more than I think it should have, and one of the indicators that we use looks at flow in the stock itself, the underlying stock, to try and suss out who is buying and who is selling based on the size of the orders and blocks that are hitting the tape. And from what I can tell, it seems like big money has been selling into this rally relatively strongly. So we have historical data that shows us that Alcoa really does not tend to do well on earnings. If we look back over the last 3 years, pick any quarter at random, it's twice as likely to have sold off across that time frame. So I would be looking to get short Alcoa. I would probably look to buy the puts either right on the slightly in the money puts at 10.5 or the 10s, and I think that based on the measured move target that market makers are pricing in for this week, either one of those would have a pretty decent chance of doubling up by Friday.
Hey Jim, I got to jump in and just tell you thank you for saying what you just said and putting me onto this, because I'm looking at my terminal right now. If you just go AA Equity ERN. Go. If you're on a Bloomberg terminal, exactly what you just said. Last quarter, for example, they came out with earnings of 7 cents. The estimate was 2 cents. So way better. And what did the stock do? It dropped 2.5%. The previous quarter, same story. Came in at 4 cents. The estimate had been 1 cent. Stock fell 9%. Before that, it was 7%. So you're exactly right. People sell into good results from Alcoa. Thank you for saying that. I didn't even realize that until
right, and that's like the exact kind of setup that I look for these short-term types of option plays, is taking a look at the historical data and saying, okay, the stock sells off way more often than it rallies. What were the actual earnings in those quarters? Well, they sell off on bad earnings, they sell off on good earnings, they sell off if they meet. That sets me up, I think, for a really nice play. And what's nice about it's kind of I typically don't like to buy outright puts ahead of earnings because vol usually tends to go down. But because Alcoa, or outright options, because Alcoa typically sells off, when a stock sells off on earnings, the vol crush is a little less dramatic than if it were to rally on earnings. So I don't have to worry too much about getting crushed in my puts. And because they're implying a move of about 65 cents here, 70 cents, either of those lines on 10.5 or 10, I think have a pretty decent chance of doubling up. Alcoa also tends to move pretty well right to the market maker's measured move target on earnings. They tend to get it pretty well nailed down. So it's like one of my favorite trades to do. I get short Alcoa pretty much every quarter ahead of earnings, and if you take a look at the historical data there, you're going to see that that trade works out way more often than it doesn't. And when you use options rather than just shorting the stock, you can set up a really nice reward to risk setup where you're getting doubling your money over the course of a couple of days. So even if you are wrong, that's okay, because when you're right, you're doing really well.
Mm-hmm. That's awesome. Great trade, James. That's good stuff. I actually wrote that down. Going to take some notes, and good start for some research. Okay, Neil, how about yourself?
I'm not normally one that's going to buy puts at a peak. I'd like to wait for the trend to reverse, make a breakdown, have a lower top. But one thing you should definitely avoid this week, I would say, is gold. Gold had its run. It had its big run up after the big Brexit vote. And speaking about Facebook, what I noticed in the last couple months is, has anyone updated their internet browsers and noticed you can't ad block anything anymore, and there's ads all over the place? And so what I noticed is that a lot of these internet companies are going super ultra aggressive on the marketing. So what I'm thinking is Google and a lot of other players in that field are going to have some really good earnings the next 3, 4, 5 quarters. And then what I see happening is they're going to start saying their expectations are going to go down because they pushed it as far as they possibly could with the advertising. So anything to do with the internet that does any type of advertising, we talked about Facebook. Google's also an option. I think buying some calls before the earnings announcements on those companies should probably work out really well because their expectations, their guidance should probably be higher. So that's what I'm looking at. And also right now, why not just do leveraged ETFs on the market? I mean, you got the triple leveraged on the S&P 500, SPXL. For your average trader that couldn't do this before, your only opportunity to make more money was in options. But now you can do these leveraged ETFs. So I would go for some leveraged ETFs on the S&P 500 and some of the other main indices this week.
Okay, perfect. I'm gonna. I'll close out with. I'm just looking at some protection. I mean, like I talked about, my strategic mindset is cautiously bullish, and with the cautiously part, that means I need to have a hedge on. I was looking at a bullish double vertical out to August or the middle of August, just because I need an ejection seat in my portfolio. I don't know what could happen. It's funny because every time I put a hedge or an ejection seat in my portfolio, I'm like, well, I want this in here in case something really bad happens. And then I go through my mind recently of everything really bad that has happened, and we end up going higher. Yeah, we might have a quick, short-term pullback, but that pullback is used as a buying opportunity. So, but that's not a reason not to hedge. As a matter of, when we were talking about earlier with the VIX being so cheap, it's almost, you can almost not buy it because it's just, It's that cheap. So I was looking at a bullish double vertical, which is actually a lot of retail traders aren't familiar with it. It's two trades on top of each other with the same strategic mindset, and then in this case, bullish on vol, whether it's VXX, VIX, whatever you want to trade, or the 30,000 other derivatives we have now for the VIX. It's a bull put spread, which is also called a credit spread, and I take some of that credit or all of it, and I turn around and I buy a bull call spread, which is a debit spread. So it's cool. It's a stacked trade right on top of each other, and people get, well, is it an iron condor? No. Iron condor is if you think something's going to be range bound. This is a double vertical, which means I use 3 reallys. You have to be really, really, really something. And in this case, I'm really, really, really bullish that between now and the middle of August, something might happen in this market to cause it to have a little bit of one of our violent pullbacks. Not saying we're breaking the 50, the 200, and doing what we did in February, but just something. It helps me sleep at night. And it's interesting because if we do have some sort of pullback or violent pullback and volatility spikes, I get out of that trade. I take my $4,000, $5,000, $6,000 and get out of it, and I deploy that over back to my longs. Because obviously, as a hedge is green on my screen, that means there's a hell of a lot of other reds, but they're longs. That's why they're called longs, right? They're out to Jan 17 or Jan 18. I like trading all the way out in time because, as many of you guys said, hey, we're going up over time, man. It's just you can't fight Mother Nature. But I like to trade the back month, but hedge the front month for now because, as you guys alluded to, sometimes trading the front month ain't too damn easy. From day to day, literally, somebody says something and we're down or up 300 points. So that's my take on what I'd be looking at. So, okay, any other around the room before I close this out, guys? Any other thoughts on my trade, each other's trades, or the overall market?
Yeah, I like your trade. Back in the day, we would have called that a risk reversal on the floor.
Correct.
But just kind of a hedged version. And, when we see VIX get this low in VVIX, which is VIX of VIX, I am a strong proponent of upside hedges. Kind of the standard institutional trade, and this is what I've been kind of pushing out, have been back spreads for even money or for like a nickel. So I was looking at the 1822 last night in August, selling 1, buying 2. September, I like the 2026. That can be done for about even money as well. Both of those look like interesting trades, but I think and for Nate and his leveraged ETF idea, what he should do is buy options on a leveraged ETF and really go leverage.
True.
Yeah, why not? Yeah.
That's a very good idea.
Well, if you can buy a call option as soon as that horse leaves the gate, I mean, you stand a pretty good chance, and you don't want to wait till he's, quarter mile into the race and he's leading and finally buy the call option.
It's always it's funny. It's always better to. I use this analogy with my traders. My dad, passed away years ago, bless his heart, but he'd have a 3 o'clock flight tomorrow. And he'd be like, hey, can you drop me off at 8 o'clock tomorrow at the airport? I'm like, did you get an earlier flight? He's like, no. I just like being there early because I'm not important enough that if I'm 1 minute late, they're going to bring that jet back. So it's better to be early in a lot of these trades and what we do than 1 minute late, like my dad said. So, all right, fellas, we are right at the 2 o'clock straight up. Perfectly, which is flawless execution on our part. So I want to thank Mark Sebastian of OptionPit.com, Adam Johnson of BullseyeBrief.com, James Ramelli of AlphaShark, and Neil Batho of TraderReview.com for being on the show today. Again, my name is Matthew Buckley, call sign Whiz from Top Gun Options, and I'll throw it back over to our gracious Uber host, David. So David, thanks for having me, bro, and I'll throw it back to you.
Thanks, guys. Did any of you want to do a final thought about your site or anything? I think you. Okay.
Yeah, we write at Option Pit. We write a daily blog at the end of the day, every day, on what's happened in vol or some type of volatility analysis every day. So if you go to our site, optionpit.com/blog, be something is valuable every day.
Okay.
That's great, Mark.
Okay,
Adam?
great.
No, just go to Bullseye Brief. It's all right there.
Cool. James?
Yeah, so you can go to alphashark.com to see all of the offerings that we have. If you want to talk a little bit more specifically about what it is that we do and the concept of unusual options activity and following the order flow in the options market, feel free to shoot me an email, james@alphashark.com. I get a whole lot of emails in a day, but I try my hardest to respond within 24 hours of receiving that. So please drop me a line. I would love to chat with you guys more about unusual options activity and how you can apply that to your trading plan.
Awesome. Neil?
You can go to TraderReview.com, and you get a lot of cool free reports on what I believe moves the markets.
Awesome, Neil. And finally, you can head to TopGunOptions.com. You can check out what we do at TGO. We do live trading throughout the week, 4 days a week. We do live training Wednesday nights at 8 for a couple hours, talking about individual tactics, and we also do coaching. So we do a whole slew of things that you can find out about at TopGunOptions.com. So David, I'll throw it over to you.
Okay, great. Yeah, thanks, guys. Great show. Just want to remind everyone who is watching that you can go to TimingResearch.com and you can download any past reports or view any of the past shows, including this one in a few minutes on there. And join us next week. We'll have Cameron Yost, Glenn Thompson, Lance Ippolito, John Thomas, and Dave Landry will be back as host. So just want to thank everyone again from this week. Mark Sebastian of OptionPit.com and Adam Johnson of BullseyeBrief.com. Thanks, guys, for being on for the first time. It's always great to have new people on the show. And James Ramelli of AlphaShark.com, Neil Batho of TraderReview.com, and of course Matt Buckley of TopGunOptions.com. Thanks, guys.
Thanks, David.
Thank you.
We'll see you.
Thanks, Dave.
Thank you.